Great. Well, what I want to look at now is an educational side by looking at technical analysis and how we can use support and resistance to assess the current condition within the euro, and in particular the euro dollar, and how we can gauge the current activity that we're seeing by using support and resistance. But I think it's important for us to just sort of take a look at what is support and resistance, and to gain an understanding of how important this is to use within a day-to-day trading strategy. Well, support and resistance are levels where buyers and sellers have previously been active. So where we've seen this type of buying or selling beginning to materialize naturally leads us to anticipate that area being an important support or resistance. Now, these can be important in uptrends, downtrends, or sideways movements. Now, support is where buyers have previously been seen. So in this chart of natural gas, we can see that the low established on June the 21st last year was an area from which the market rallied back sharply. So in other words, we saw strong buying support developing at that level. Now, that naturally leads us to look at that as being an important point where, because buyers have previously been found from it before, that will potentially act as an area where buyers will be found again. So the market can correct back to it, but continue to find the buying activity or the support within the market, a demand for the asset that we're analyzing, and that will again consistently act as a support level from which the market can rally up. Now, resistance is where sellers have previously been evident and where we can anticipate supply or selling pressure beginning to materialize once more. And here we have the dollar-yen chart on a weekly basis, just to highlight the significance of the previous resistance points, the previous highs from where we've encountered selling pressure, dating back to October 22, November 23, and again this month around the 151.96 area. So while this point remains intact, the potential is for further selling pressure to materialize. But obviously, as we've seen so far in reaction to the latest CPI data, the dollar has been able to break through this point. So we've seen a break of resistance, and that itself can offer us a trading analysis and a strategy that we can use to adjust our trading positions. So how can we use support and resistance on a day-to-day basis? Well, we can use support as an area we can work bids if we want to get long of the market. And we would work those bids just above the support area, just to give the market a little bit more room, just in case we don't correct back and match that support point exactly. We could also use support as an area where we anticipate the market rallying from. And if we're short, we could use that to close those positions. Or we could view support as an area where we can get long. We're looking for a correction. Maybe the market's become overextended to the upside in our another analysis. And we're looking for a correction back towards the support point so we can look to get long against it. And we can also, if we're holding a long position, look at a support level as being an important trigger point. So we can place stops just below a support to protect our position just in case we start to see a more extended sell-off beginning to materialize. And then vice versa with resistance. We can work offers against that resistance just below the point if we want to get short of the market. We can take profits. So if we're long and we're trading up towards a resistance focus, a significant previous high, we can view that as an area where we may potentially fail again, and the market could see a correction beginning to develop from it. So again, we could look to take profits against that area. Or if we're short of the market, we can view a resistance area as an important pivot point within the market, because if we start to break it, that may well trigger a more extended and prolonged move to the upside. So again, if we're short, we can place stops just above that level to protect our position. So how can we use support and resistance within a sideways range? Well, A sideways range is a decision-making process between buyers and sellers. Buyers and sellers are active at a certain level each time. And if we look at an old chart of the euro dollar, for instance, we can see that buyers are found consistently where we've marked the previous lows and this horizontal support line. So this marks the support level. We then get a parallel resistance point where the buyers have been held and we start to encounter sellers around the resistance area, the previous highs, to see extension of this choppy sideways trading activity, this decision-making process to see who actually comes out on top, be it the buyers or the sellers, at which point we will see a breakout occur. Now, this range develops until we see a breakout from one side or the other, where we start to see, in this case, the buyers overcoming the sellers. So there's more buying demand to overcome the selling resistance and supply at that particular level. And this is when we see a breakout occur. Now, note how the market accelerates higher once we start to see a breakout developing. Now, this is because something called the supply vacuum. And this simply means an area where there are no offers within the market. The reason this supply vacuum occurs is because the longer the sideways trading range goes on, if you're working an offer above the market or a bid below the market, and you're constantly frustrated because your offer's not getting activated either to the up or to the downside, you pull your offer and bid into the old range because you'll know you've got more chance of actually becoming activated and trading within that area. So we look at price action, and once we start to break up and take out the resistance point, the market accelerates within the supply vacuum and effectively then moves to the next point where we start to see offers within the market, where they've no longer been pulled lower in to extend this sideways trading range. And even when a correction is seen, you'll note in this example here, when a sell-off did occur as a correction towards this recent upside move, it was the old highs and the previous sideways activity where buyers again were found. So effectively, this old resistance level became support where buyers are then active, and that looks to then push the market higher because the old resistance line has acted as a support point. So previous sellers at this level may well be covering their short positions because they've got an opportunity to act at a similar or at the same level. And that acts as a support point from which the market can push higher. And it may well develop a bullish trend. Now, within the euro dollar, this is exactly what happened, because here you can see that sideways trading range that we were just looking at. And what actually happened within price activity once we started to see that successful upside break. And this is when the breakout from the range reflected a bullish sentiment shift and the formation of an uptrend. And that is obviously a bullish pattern. Now, this is where buyers develop at higher levels each time after correction of strength from new highs. So if we think about that in terms of a sentiment aspect, it's bullish because it takes less of a correction to attract buyers back to the market to get long and to push the market to new highs, to break above the previous failure level, which is a resistance focus. And once we start to push higher, we see the formation of this bullish trend, the pattern of higher highs and higher lows, and that reflects bullish sentiment shifts. Any corrections are limited and much smaller than the upside moves. Again, because we're looking at bullish sentiment, it takes less of a correction to attract people back into the market to push higher and make new highs for this particular move. Sometimes, but not always, and don't be too concerned if it isn't available, but sometimes you can draw a line that connects the lows that acts as a support point. So it highlights the area where we anticipate buyers to be found again. And this is called a trend line, in this case, an uptrend, to reflect that support point and the ongoing bullish sentiment within price activity. It may well be that we'll see acceleration within the original uptrend, so we get a steeper trend line moving higher to reflect a steeper and higher support point as that bullish sentiment continues to build, but always within a pattern of higher highs and higher lows. What I would say is don't get too fixated on a trend line. It's more the fact that prices are making higher highs and higher lows that's important. And once we start to see that last correction low of a bullish trend give way, whether there's a trend line there or not, for me, it reflects a potential negative sentiment and the risk of a downside move beginning to develop. So when we look at the opposite, the bearish trend or a downtrend, we see exactly the mirror image of an uptrend. Corrections or weakness is more extended and recovery moves are much more limited in terms of a reaction to the downside selling pressure that we've seen. So again, it's negative sentiment. It takes less of a recovery to attract fresh selling pressure and to see further downside beginning to develop to extend the ongoing bearish trend to new correction lows. So we consistently see that negative sentiment dominating and forming a pattern of lower highs and lower lows. Again, you may be able to connect the highs of the downtrend with a straight line called a downtrend, and this marks the resistance point. But it's also the fact that we're still seeing lower highs and lower lows that dominates that pattern and the negative risk. And that, for me, is the critical point. The lower highs and lower lows is still the evidence of negative sentiment and the bearish trend continuing to build. Now, once we start to see positive sentiment beginning to materialize, we may break the downtrend. But once we start to see the last failure high also give way, then that reflects a more significant sentiment shift back to the upside to reverse what has been a bearish trend and obviously an opportunity to be short of the market. So any break of a previous high or downtrend is a warning signal that we may well start to see a more sustained upside move. Okay, so what I want to do now is to look at the current position for euro dollar from a support and resistance perspective and just sort of try and highlight where risks are beginning to materialize. Now, obviously, we've seen it earlier, CPI released, and that has seen further US dollar strength and euro weakness, and the market has sold off. But you'll notice within the weekly chart that we have here that a downtrend has been in place since late December last year. And this week, that has acted as a resistance level. So we've moved back to the downtrend, found selling pressure, and as a reaction to the data, seen fresh declines beginning to materialize. So does this mean that the downtrend can extend? Well, potentially it could be. But if you also note, we've got an uptrend connecting the recent lows, which stand at 107.18. So this is the important support point to the downside within the current weakness from a longer term weekly perspective. And if that starts to give way, then it could reflect a more serious negative sentiment shift and the breakout from the current range that we're seeing. And that may well start to suggest if we break to the downside, we may see further weakness towards the October 23 lows at 104.48. Or if we start to break the downtrend at 108.93, that could open the way back towards the December highs, just above the 111 figure. So we know the important support and resistance levels to monitor within this type of price action for the weekly perspective. So let's have a look at the daily view and see how that links with the weekly outlook. Well, you can see that we've seen a very choppy sideways trading activity developing for the daily perspective. And this is obviously the reaction to the CPI data that we've seen earlier on today. But again, we've broken below the declining Bollinger Mid average, which is highlighting deterioration within the overall structure. And we're heading back towards the April 2nd low of 107.24. So again, that low, especially linked with that uptrend that we were seeing within the weekly perspective, highlights an important support level. So while the current weakness suggests that we can see pressure build on this low, it would really need to give way to develop negative themes, and the risk would then be down towards the February 14th low at 106.94, and possibly further if that starts to give way, because then that links with that weekly perspective and the risk of a deeper sell-off beginning to materialize there as well. So I think, certainly the overall risk is one where we can see further selling pressure, further test of these lows, and the potential for a deeper sell-off to materialize once we start to see these support levels or the resistance to the upside start to give way.